I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight to the burning issues in private markets. Embracing the pain, investors looking for ways to profit from growing distress in China. Painting a bleak picture, coronavirus hits fine art sales in Asia as buyers stay home and auction houses go dark. And we talked to Neuberger Berman's Tony Tutrone about playing a perilous field in an aging economic cycle. Let's get into some of these burning issues. With me is Bloomberg Sonali Basak, Katya Kazakina, and Damian Sassower. Sonali, let's get started with you. Today, you were at the JP Morgan Investor Day, and the CFO commented about the rising pool of dry powder at private equity firms. What was their main point there?
So on one hand, you have their investment bankers that love this dry powder pool because it means that theoretically private equity firms have a lot to put to work on deals. But it doesn't mean always that they're using them. I've talked to other investment bankers who call this dry powder issue a myth. And they say that even though the dry powder is there, it's still hard to put to work because valuations are still high.
They said that it was $2.5 trillion of dry powder, which is actually somewhat higher than the estimates that we have from other data providers. They also said, though, that this was a potential competitive threat to them.
It can be a huge competitive threat. If you think about it, this private equity industry, it's not just private equity, it's private credit, real estate, infrastructure. These are all areas where JP Morgan is a huge bank. It's a huge lender. And so you have JP Morgan in some ways competing with these other firms in those markets.
All right. They talked about private credit. And art also has been one asset class that people have had in focus recent. Katya, there's been a direct impact from the coronavirus on the Asian art market. Katya, can you give us a sense of how much it's been disrupted?
So Asia is a massive market in the art world, and made a big art fair, Art Basel, Hong Kong, has been cancelled. It was supposed to take place next month in March. And last year, it attracted close to 90,000 people from all over Asia. So that is off the charts. Then auction houses had to, in some cases, postpone their sales and or remove them, relocate them to New York.
Which raises a question to me: how much more are Asian buyers accounting for as far as the buying goes of fine art?
It was a huge part of the market, 19% in 2018. That's the last data we have. So it's about $13 billion worth of sales. And some of the major artworks that went to Asia, for example, the Modigliani that sold for $170 million several years ago, that went to China. You know, and Chinese collectors have been some of the most active buyers at auction, at art fairs, and so their inability to travel, for Asia Art Week in New York next month as well, 500 to 1,000 Chinese collectors came to New York every year, and now they can travel. So a lot of auctions that take place in conjunctions with gallery exhibitions are postponed till June.
Do people have a sense of whether this is temporary or permanent?
Well, we'll hope it's temporary, right?
We'll see. I think that there's a question, too, when looking at China, which brings us to Damian Sassower. There have been a number of stories about Chinese companies on the brink, potentially poised to default if there isn't some sort of bank rescue or if there isn't a resumption of business in the face of the coronavirus threat. Damian, can you give us a sense of how significant the threat of default really is here?
Well, Lisa, I don't think we're talking about a mass bailout per se, but certainly the questionable loan ratio within China's banking system is going to rise, and that can take a long time to work out once it does. But in terms of the numbers, look, I mean, what we're talking about is $9 billion of China dollar debt, which is currently stressed, meaning it has yields in excess of 15%. Of that, $2.1 billion is coming due in March alone. Now, shifting to the local currency China debt, we have $40 billion of stressed, of which something on the order of $15 billion is maturing in the March-April period. So this maturity wall is building. It's right in front of us. And look, if you just look at just last Friday, we had Founders Group defaulting on a $285 million bond, local currency China debt. That's going to be a pretty good gauge of how the state is. It's going to be a state-run workout. It's going to be a pretty good gauge of just how China is going to allow these companies to default and what the recoveries are. Because some of the recoveries we've seen, I'm talking 30, 40 cents on the dollar for Taiwan low and king high, I mean, it's going to be interesting from a creditor perspective for sure, Lisa.
Damian, thank you so much, and to all of our reporters, we appreciate it. It brings us to my next guest, Leland Miller, China Beige Book Chief Executive Officer. He says that the credit environment may still be the single most crucial lens through which to view the Chinese economy. Leland, there's a big question about what the first quarter impact is of the coronavirus and the subsequent shutdowns of major metropolitan areas in China. You've collected some non-official data. Can you give us a sense of what it shows?
Well, it's a lot worse, I think, than what most of the consensus has been up until very, very recently. The question is how much are people back to work? It's not just about going back to work. You have a certain percentage of the firms, maybe 30% of firms that are closed altogether. You have another, say, 30% of firms that are either working remotely, or their CEOs aren't showing up even though their workers are, or they're technically open for business, but they're not really doing anything. So, you have an enormous amount of percentage of the economy right now that's just not working. That's not good for growth.
And, there was a story on Bloomberg talking about millions of small to medium-sized companies that will run out of cash in the next 30 days if they don't get some sort of reprieve from banks. Do you expect these companies to actually default or go out of business, or do you think the government will likely step in?
No, the government's going to step in. I mean, look, there will be bankruptcies. There will be firms that do not survive this. But this is a case study in all the advantages of a centralized system. When you have a party that controls all the counterparties in the economy, you have state banks loaning to state enterprises. You have state banks loaning to small, medium-sized enterprises, but you could tell them to lend. You have the ability to just continue to get the process going. You never have to freeze up liquidity in the same way that a commercial financial system would work. So if it's the policy choice to keep these firms afloat, then the firms will be kept afloat.
Okay, so this raises a serious question for the Oak Trees of the world and the other major alternative investment firms that have been going into China or pinpointing that as the next point of opportunity, seeing that there probably will be more distress. There have been record numbers of defaults. Do you think that that is misguided in the sense that these companies will not be allowed to default?
Look, there are distressed assets in China. It's a wonderful place for distressed assets. So part of it's just pricing out where there are values and where there are not values. But the idea that you're going to have this wave of defaults at anything other than a very catastrophic scenario, I think is pretty unlikely. And one of the major problems we've seen year after year after year, even by the most sophisticated Wall Street players, is they go into China and they think they're dealing with any other country. They think they're dealing with a commercial financial system. They think their risk models, based on very questionable data to start with, are going to end up panning out. And it never plays out that way.
So what have recoveries been like of the companies that have been allowed to default?
Well, I mean, usually when you have very few defaults, I mean, historically you've had almost no defaults. What usually happens is a third party, a government or a government representative steps in and negotiates some sort of payment. For a bunch of years when we thought we were going to see defaults, you got everything back still. You've seen some defaults in which very recently, in which investors have gotten only, 30 cents on the dollar, 50 cents on the dollar. That was where they're moving. But look, there's a political element here too. This is not just a gradual moving towards a more risk-based system, which is what they should have been doing the whole time. There is now a political issue with the party. There is a Xi Jinping issue. Is there any loss of control? So this is not going to be treated as if there was a no coronavirus outbreak. This is a new paradigm. And so the idea that they're just going to continue on and just, allow firms to fail as part of some grand experiment, the scenery's changed.
Leland Miller, thank you so much for being with us, raising some serious questions about the distressed debt and equity investments over in China. Leland Miller, Chief Executive Officer of China Beige Book. Coming up, Tony Tutrone, Neuberger Berman, Global Head of Alternatives, tells us if the virus alters his thinking on private debt and equity. That's up next. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for our Power Player, a look at some of the most notable names in private markets. The question of the day is how much the spread of the coronavirus changes the game for all markets, including private debt and equity, and remaps expectations for profits and global growth going forward. Take a listen to what Ares Management CEO Mike Arougheti had to say about this earlier on Bloomberg Television.
Coronavirus is the topic of the day. Last year it was the trade war. The months before that it was North Korea. So there's always something in the headlines. I think we have to be keyed into that and understand what that can mean for our portfolios and the deployment. But as long-term investors in the private markets, we have to look past that and really focus on 5 to 10-year horizons.
Joining us now with more is Tony Tutrone, Neuberger Berman Global Head of Alternatives. Tony, is there anything about the recent developments with the coronavirus that makes you rethink any of your investment theses over the next 5 to 10 years, let alone 1 to 2?
Yes. Thank you, Lisa. Great to be on the show again. So, of course, we have to think about something like this. I think in private equity, though, even though this is a human tragedy and it's causing a lot of problems in the short term, my guess is over a 5 or 10 year period, it's not going to influence results that much. But all that said, we have to be very careful about the companies we're looking at right now and making sure that their supply chains are diversified and that they're prepared for these type of events, because these type of events, maybe not this particular one, will probably continue to occur in the future.
On the flip side, do you see opportunities opening up with companies getting much cheaper to potentially swoop in and buy?
I wish. I have not seen companies getting cheaper.
Okay.
Maybe that will happen in the future. I know there's a lot of volatility in the markets right now, but we have not seen that reflected in pricing to date.
All right. Meanwhile, another consequence of this has been that interest rates, benchmark yields, have been heading to all-time record lows. And I'm wondering how that affects private equity returns going forward, just given the fact that all valuations are going up, expected returns going down.
Yeah, I think the valuations are very much connected to where the risk-free rate is, the 10-year rate. So if you have a risk-free rate at 1.3%, then the multiples that are being paid for businesses right now seem more reasonable. But if those rates come up, then that may not be the case. So I really think, one of the keys for private equity going forward is making sure that you're hedged against interest rates moving.
How do you do that?
Well, the way we do it is by making sure that the capital structures that you're putting in place are sound and they can withstand an increase in rates. But you can also use the capital markets, right?
Meanwhile, there was an article in the Financial Times this week taking a look at returns in private equity over the past decade. A Harvard professor talking about how they've actually been below on an annualized level. The S&P 500, Professor Lerner of Harvard, saying that there's been a huge influx of money into private equity, but when you look at the returns numbers from the last decade, it's hard to feel that there's really been much alpha at all. What's your response?
So my response is, the good news is that investors in public markets and in private markets have done exceptionally well over the last 10 years. So that study, which goes from June of 2009 to June of 2019, said that the public markets, the S&P 500, returned 15.5%, and the private markets 15.3%. Both great numbers. The key is nothing has changed in private equity. Those are good numbers. What happened is we've had a tremendous bull run in the S&P 500. And in those bull runs, it makes it very difficult for private equity to maintain its spread on returns.
What do you say to people who say that private equity has also had an equally good run during this bull market, given the influx of capital into that sector, and that those returns will also be somewhat lower in the years ahead?
Look, it's a very good point, but private equity, the spread between private equity and public markets tend to converge in times of long bull markets. The last time that happened was in 1999, after a decade-long run in the markets. But when markets are choppier, more volatile, or going down, that's when the outperformance tends to grow. So we can see just in the last few days that volatility does occur in the public markets.
So when you talk about that during choppy periods, since we seem to be in one at this very second, perhaps not in 1 hour, do you think that there are opportunities there to actually buy, or is it just that you're not exposed to the same volatility in pricing because it doesn't price in real time?
Yeah, what I'm really saying is in prolonged periods of volatility, downturns, choppier markets, private equity firms have some advantages, right? Because they control the companies, and their companies tend to make changes to deal with the environment more quickly. They cut costs, they conserve cash. And what's lost on a lot of people is that private equity has a pool of capital that is always available to these companies. Public companies, family-owned businesses don't always have pools of capital that are available to them to play offense during times of stress. And the only other thing I wanted to point out on these returns, that's just for the U.S.
Yeah.
Because the spread of privates over publics in Europe and Asia has been maintained even in that study.
Tony Tutrone, thank you so much for being with us. Tony Tutrone, Neuberger Berman, Global Head of Alternatives. Coming up, going private. Again, L Brand's Victoria's Secret is the latest public company to exit the public market. More ahead, this is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. It's been a revolving door from private to public, back to private again. Last year's IPOs were marked by an incredible plunge in the share price, raising questions about valuations. Joining us right now, Kathleen Smith, Renaissance Capital founding principal. Kathleen, thank you so much for being here. I want to start with the news of the day, which is the coronavirus, given the fact that we've already seen some trepidation in the IPO market with Casper, for example, getting a valuation from prospective IPO investors lower than recent private market funding rounds. How much do you think the recent jitters will dampen the IPO market?
Well, the important thing about the IPO market is the returns, and investors have made very good returns in IPOs in 2019 and so far this year. The reason is that investors are pretty price sensitive, and they're not taking high valuations. They're cutting those down in order to make good returns. Now, the problem we have coming into 2020, we knew we have the election at the end of the year, and that usually dampens activity. But now we've got the virus, and what that is going to do is that is slowing down the companies that are lined up to go public this year. Warner Music is set up. We haven't seen that deal launch. We haven't seen the deals for Cole Haan. They're on. Madewell is on the calendar. AZEK is on the calendar, an alternative wood company. So we have a very slow start now. Coronavirus is hurting issuance and will, because when the markets are volatile like this, IPOs just don't get done. That's a problem. IPOs are like the canary in the coal mine for liquidity in the private markets. And it looks like the liquidity is going to be shut down for a little while.
All right, so let's build on that. The idea being that even Casper, which was the roadshow was started before the coronavirus fears started to pick up steam, was seeing valuations in the IPO market substantially below the last round in the private market. What do you take from that?
Casper isn't the only one that's had these problems. I mean, Casper had a private valuation of $1.1 billion and went public with a valuation of a little below $500 million. A huge cut, but it's not the only one that's had this cut. It's because the IPO market, it's not like 99-2000 when retail investors were jumping in with both feet. The IPO market right now is a very price-sensitive place, mostly institutional and hedge funds, and these pools of money, they're not in the market to lose money. So they're not going to jump on the last round. And it tells you that the private market has very excessive valuations. That's what the public market has had a hard time reconciling.
What would you say to people who push back on that and say, well, actually, the companies that are going public are the weaker ones, are the ones that are not necessarily turning a profit yet, even though they're later stage, and that there still are a lot of private market valuations that make sense?
Well, at this stage in the cycle, I would say that the strong ones have come out, and it's the weaker ones that are trying to get out now. And the private investors are trying to get these companies in shape so that they can show the public market a kind of narrative, the business story that makes sense and a valuation that makes sense. The reason for the lockup in getting liquidity is that the private investors don't want to take a markdown in the public market. That's why they're waiting. It's like selling a house and knowing if the market's weak, you have a high price, you wait to sell until you think you can get a better price. But I think they're waiting too long.
Is there a historical comparison to what you're seeing right now in the prospective IPO market?
We haven't seen anything like this. I mean, we've been doing this for 30-some years. I mean, it's a complete flip-flop from what the market was perceived to be during the internet bubble, a complete flip-flop. But it's sort of the price discovery, the way the IPO market is trying to figure out how to absorb these companies. They have to fit in to the public company landscape. It can't be some crazy valuation when the rest of the peers are trading at a more rational valuation.
You spend your days crunching the numbers, looking at the fundamental balance sheets. How much do you think that private market valuations right now, as a whole, based on what you've seen from prospective IPO candidates, is overvalued?
A lot. Could it be 30% more than they should be? It's hard to have that. That's a very hard piece of data to get. But for us, it appears that they're very highly valued and valuations need to be cut. That's why these companies are waiting. They're thinking time may help with that better valuation, but I don't see it happening. Right now, the average company that's private is 11 years in private hands. You know, you're not a private investor to stay in these forever. You've got to find liquidity.
Well, here, we had Tony Tutrone of Neuberger Berman just on, and he was saying the one unique characteristic of private equity money is that there is a pool of capital committed to keeping those companies afloat and sufficiently funded through their history. So what's sort of the catalyst here to sort of call the hand on valuations that you see as excessively high?
That's a very good point. The catalyst, I think you can look at the IPO market as a catalyst. If the IPO market shuts down, which is happening now, and we're not sure how long it will be, then one path to liquidity is gone. If the market is telling us that we're in a recession, private companies are businesses just like public companies. So if those companies are stressed, they don't have as many avenues of liquidity. The trigger would be the closing down of an avenue of liquidity, which would be the IPO market, and then also some kind of business slowdown that says, how many can I keep these companies going who need additional capital?
Kathleen, just real quick here, is the reason the IPO market is shutting because of the coronavirus, or is it just, was it slowing before that?
No, the market was very healthy coming into the end. It is slowing because of the coronavirus, and that's an unexpected thing. So be warned if you're looking for liquidity in the public market.
Kathleen Smith, Renaissance Capital Principal, thank you so much for being with us. And speaking of big money, it's time for this week's big number. It is 57%. That represents the percentage of private equity fund general partners that think the economy has reached a cyclical peak. Reminder, that does it for us. You can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, and 2 a.m. in Hong Kong. From New York, this is Bloomberg.